The Strait of Hormuz is under threat of closure. If you do not know what that means, you're about to find out. Because if the Strait of Hormuz closes, even temporarily, the ripple effects through global financial markets will be unlike anything most investors alive today have ever experienced. Gold is already eyeing $6,000 per ounce in response. And silver, sitting at a historically cheap ratio relative to gold, could be about to make the move that precious metals investors have been waiting years for. My name is Stack AG, and today, this is the most important video I have made on this channel. Before anything else, let us make sure every single person watching understands exactly what the Strait of Hormuz is. Because without understanding this, nothing else in today's video makes sense. The Strait of Hormuz is a narrow waterway, approximately 33 kilometers wide at its narrowest point, located between Iran and the Arabian Peninsula. It connects the Persian Gulf to the open ocean. That sounds simple. Here is why it matters enormously. Approximately 20% of all the world's oil passes through the Strait of Hormuz every single day. 20%, 1/5 of global oil supply, flowing through a channel 33 kilometers wide. Every oil tanker leaving Saudi Arabia passes through it. Every tanker from the UAE, from Kuwait, from Iraq, from Qatar, which supplies a significant portion of Europe's liquefied natural gas. All of it flows through this single narrow waterway. Iran has repeatedly threatened to close the Strait of Hormuz during periods of geopolitical tension. They have the naval capability to make that threat credible. And right now, with US-Iran tensions at levels not seen in years, that threat is being taken seriously by financial markets for the first time in a long time. If the strait closes, even for 2 weeks, global oil supply drops by 20% overnight. Energy prices spike immediately, inflation surges. Supply chains that depend on affordable energy break down, and financial markets, which had already been nervous, go into full panic mode. That panic has one primary beneficiary, always, throughout history, without exception, gold. And Silver.Gold is already responding to the Strait of Hormuz threat, and the market is now openly discussing $6,000 gold. Let me explain why $6,000 is not as crazy as it sounds. Gold at $5,000 seemed impossible 18 months ago. It is now reality. The same structural forces that drove gold from $2,000 to $5,000 are not only still in place, they are accelerating. Central banks are still buying. China just completed 16 consecutive months of gold purchases without a single pause. That buying has not stopped. It has not slowed. It continues. Dollar weakness is still in effect. The Federal Reserve's rate cut cycle has not reversed. Dollar-denominated assets are still losing appeal relative to hard assets globally. And now, on top of all of those existing structural forces, a new geopolitical risk premium is being added. The Strait of Hormuz threat adds an entirely new layer of fear to markets that were already nervous. Fear is rocket fuel for gold. When investors are uncertain about energy supply, which powers every single economy on Earth, they run to gold. Not ETFs, not bonds, physical gold. Capitalite's analysis published this week states clearly, gold now has a credible path to $10,000 by 2029. $6,000 is not the ceiling. For some serious analysts, $6,000 is the next stop on a much longer journey. Now, here is where Stack AG connects the dots that most channels miss completely. Everything driving gold higher, the Hormuz threat, the central bank buying, the dollar weakness, the geopolitical fear, every single one of those forces also drives silver higher, simultaneously. But silver has an additional driver that gold does not have: industrial demand. The same Iran tensions threatening the Strait of Hormuz are also threatening oil supply. And threatened oil supply accelerates the global transition to renewable energy. Solar panels, wind power, electric vehicles. Every government on Earth watching oil supply get threatened through a 33-kilometer strait is reminded why they need to reduce dependence on fossil fuels. And every solar panel, every EV battery, every renewable energy installation requires silver. So the Hormuz threat simultaneously pushes silver higher through fear premium and pushes silver higher through accelerated renewable energy demand. Two separate mechanisms, both triggered by the same geopolitical event, both bullish for silver. Meanwhile, the gold-silver ratio sits at approximately 70-1. With gold eyeing $6,000, silver at a 60-1 ratio would be $100 per ounce. At 50-1, $120. At 40-1, $150. Silver is not just cheap relative to gold today. Silver is historically extraordinarily cheap relative to gold at a moment when every fundamental force in the market is pushing precious metals dramatically higher. Let us talk about the actual scenario that markets are now pricing in. What happens, specifically, if the Strait of Hormuz closes? Day one, oil prices spike immediately. 20% of global supply disappears from the market overnight. Brent crude moves above $150 per barrel within hours. Gasoline prices surge at pumps across Europe, Asia, and North America simultaneously. Day three, stock markets begin selling off aggressively. Energy-dependent industries, airlines, shipping, manufacturing, agriculture, all face immediate cost explosions. Risk
Corporate
asset
earnings
inflation
sell-off
communications
market
surge.
flash.
Central
Globally,
banks face an impossible choice. Raise rates to fight oil-driven inflation and crash already fragile economies. Or keep rates low to support growth and watch inflation accelerate beyond control. Day 14, capital flight into hard assets reaches maximum velocity. Gold breaks through every resistance level. Silver, which had been lagging gold, begins its explosive catch-up move. Physical silver premiums over paper prices surge as investors demand the real metal, not paper promises. This scenario is not guaranteed to happen. The strait may not close. Diplomatic solutions may emerge. Military deterrence may hold. But the fact that financial markets are pricing this scenario in, right now, today, means the fear premium in precious metals is real. And fear premiums in gold and silver historically do not reverse quickly. They build, they compound, and they culminate in price moves that leave late investors wishing they had acted when the data was clear. The data is clear right now. Here is a second major story from this week that connects directly to silver and gold, and that almost nobody is talking about in the context of precious metals. Private credit risks could trigger a prolonged economic downturn, supporting higher gold prices. Private credit is a $2 trillion market of loans made outside the traditional banking system. Unlike bank loans, private credit is not regulated the same way. It is not as transparent, and in an environment of higher interest rates. The stress on these loans is building quietly beneath the surface. If private credit stress triggers a broader economic downturn, central banks respond with one tool: liquidity, money printing. Every dollar of stimulus that enters the financial system is a dollar that reduces the purchasing power of existing dollars. And every reduction in dollar purchasing power is a reason to hold assets that cannot be printed, physical hard assets. The private credit risk story and the Hormuz story are completely separate events, different causes, different mechanisms, different timelines, but they both lead to the same destination for precious metals investors: higher prices through completely different paths simultaneously. When two independent crisis scenarios both point to the same asset, that is not coincidence. That is signal, standard disclaimer, always. Nothing in this video is financial advice. This is data analysis and education only. Always consult a qualified financial professional before making any investment decisions. Now, practically, what does today's news mean for you? If you already hold physical silver, the Hormuz story strengthens your position significantly. You now have a new geopolitical catalyst on top of all the existing fundamental drivers we have covered on this channel. Industrial demand.comics vault drainage, central bank buying dollar weakness. And now, oil supply threat accelerating renewable energy transition and safe haven flows simultaneously. Your thesis has never been more supported by independent data points. If you hold paper silver, ETFs, or futures positions, understand that in a genuine geopolitical crisis scenario, the spread between paper and physical prices can widen significantly. Physical silver in your direct possession carries no counterparty risk. Paper silver depends on the solvency and reliability of the issuing institution. In a crisis, that distinction matters enormously. If you are on the sidelines watching, I understand the psychological difficulty of entering a market that has already moved. But consider this: the structural forces driving this move are not one-day events. Central banks do not stop buying gold because of a single news cycle. The Hormuz threat does not resolve in 24 hours. Private credit stress does not disappear overnight. These are sustained structural multi-month forces. Waiting for a pullback in that environment means potentially waiting a very long time. Dollar cost average. Start small. Build a position over time. Remove the emotional pressure of perfect timing. And one final reminder: we do not sell silver. We do not sell anything on this channel, ever. Anyone contacting you claiming to be Stack AG and offering to sell precious metals or investment products is a scammer. Block them immediately, report them. Protect yourself. The Strait of Hormuz has been called the world's most important oil choke point for decades. Today, for the first time in years, its potential closure is being taken seriously by global financial markets. Gold is responding, eyes on $6,000. Silver, historically cheap. Industrially essential, monetarily undervalued. Safe haven activated, renewable energy demand accelerating. COMEX vaults draining. Every single force in the market is pointing in the same direction for silver right now. The investors who will benefit most from what comes next are not the ones who act after the move is obvious. They are the ones who read the data when it is clear, and act with conviction before the mainstream catches up. Stack AG is here every single day. Every geopolitical development, every vault report, every central bank decision, every macro shift. So you always have the data first. Subscribe, hit the bell. Share this video with one person who needs to understand what is happening in global markets right now. I am Stack AG at Invest with Logic. Not hype. See you tomorrow.